Something unprecedented just happened in America. The Department of Justice is going after the Federal Reserve Chair, Jerome Powell, and here's the part most people are missing. Gold didn't wait for headlines. Gold moved first. When the market starts questioning the independence of the Federal Reserve, trust in the dollar weakens. Quietly, but fast. That's why gold is at record highs. That's why silver is exploding. This isn't unpolitical drama. This is a warning signal about money, inflation, and what happens when power touches the system that controls interest rates. To understand why gold and silver are reacting so aggressively, you first need to understand what actually happened. Stripped of noise, politics, and social media exaggeration. For the first time in modern U.S. history, the Department of Justice has opened a criminal investigation involving a sitting chair of the Federal Reserve, Jerome Powell. That alone is historic. The Federal Reserve is designed to be independent from political power. That independence is not symbolic. It is the backbone of confidence in the U.S. dollar, U.S. bonds, mortgage rates, and the entire global financial system that runs on. Dollar liquidity. When that independence is questioned, markets don't wait for verdicts. They react to risk. What is the investigation actually about? Officially, the DOJ probe focuses on whether Powell gave misleading testimony to Congress regarding cost overruns tied to the Federal Reserve's headquarters renovation project. On paper, this sounds minor. In reality, it's not about construction costs. Markets are forward-looking. They don't tone price the past, they price precedent. And the precedent here is dangerous. If a sitting Fed chair can be criminally investigated while still in office, the Fed is no longer politically untouchable. That single idea changes everything. The tall. Why, this is not just another Washington drama. Most Americans hear DOJ investigation and think in terms of guilt or innocence. Markets think in terms of system stability. The Federal Reserve controls interest rates, money supply, liquidity during crises, inflation expectations. That power only works because markets believe the Fed acts without political coercion. The moment investors believe rate decisions can be influenced, legal pressure can force policy changes. Monetary policy is no longer neutral. Confidence erodes. And confidence is the real currency. Why gold reacted before stocks? Stocks are emotional. Gold is instinctive. Gold doesn't care about press conferences, elections, or speeches. It reacts to credibility risk. The moment this investigation became credible news, gold surged not because of headlines, but because of what this means if it escalates. Historically, gold spikes when central banks lose trust, political power interferes with money, inflation risk becomes unpredictable. This is why gold often moves before recessions, crashes, or currency stress events show up in mainstream narratives. Silver follows, but more violently because it's thinner, more speculative, and reacts like leveraged gold. DAWs. Why the dollar is at the center of this. The US dollar is not backed by gold anymore. It's backed by institutional credibility, legal independence, monetary discipline. The Federal Reserve is the keystone of that structure. When foreign governments, global banks, and sovereign wealth funds look at this situation, they aren't asking, is Powell guilty? They're asking, can the Fed still say no to political pressure? If the answer becomes unclear, capital begins hedging. That hedge is gold. That hedge is silver. That hedge is moving money out of pure dollar exposure. STOL. Why this matters to everyday Americans. This isn't abstract. If Fed independence weakens, the ripple effects hit. Mortgage rates, credit card interest, auto loans, inflation expectations, retirement portfolios. You don't need charges. You don't need convictions. Markets move on probability and perception. What makes this moment different from past Fed criticism? Presidents have criticized the Fed before. Congress has pressured the Fed before. What's different now is legal escalation. A DOJ probe introduces legal risk, career risk, institutional fear. That changes how policy decisions are perceived, even if nothing changes on paper. Markets price fragility, not intention. Even if the tariff were removed tomorrow, the memory of it would linger in every risk model. Banks, refiners, and lodge holders have now seen how quickly politics can freeze, meddle in place. Once that lesson is learned, behavior changes for years. You can already see that shift forming. Physical silver is being treated less like a tradable commodity and more like a territorial asset. Holders prefer jurisdictions where movement is predictable, taxes are stable, and exit is not politically weaponized. Right now, that preference tilts toward the United States. For London, this is a slow squeeze rather than a sudden collapse. Inventories do not vanish overnight. Instead, they stop being replenished at the margin. Shipments get delayed, deals get repriced, premiums creep higher, liquidity thins quietly before anyone notices on a chart. To understand why gold and silver moved so fast on the DOJ Powell news, you need to understand what role these metals actually play in the financial system. Gold and silver are not just investments. They are stress detectors. They respond not to headlines, but to loss of trust. Gold does not chase returns. It prices credibility. Stocks rise on growth. Bonds rise on confidence. Gold rises when confidence starts breaking. Gold's primary function in global markets is simple. It measures trust in governments, currencies, and central banks. When that trust is solid, gold stays quiet. When trust weakens, gold moves, often before the public understands why. That's exactly what just happened. Why gold moved before stocks or housing. Equity markets are slow to accept uncomfortable truths. They rely on earnings narratives, liquidity, and optimism. Gold doesn't wait for confirmation. It reacts to risk probability. What silver is signaling specifically, silver's move is telling you something gold can't express alone. Silver reacts when retail participation increases, speculation accelerates, inflation hedging spreads beyond institutions. When silver starts outperforming gold, fear is spreading from professionals to the public. Volatility is increasing. Market narratives are shifting fast. Silver doesn't whisper. It shouts, "Daw, daw." Why this matters, even if you never buy gold or silver? You don't need to own metals for this to affect you. Rising gold and silver prices often precede higher long-term interest rates, volatility in stocks, pressure on the dollar, policy shifts at the Fed. They are symptoms, not causes. Ignoring them doesn't protect you. Understanding them does. Key takeaway from part 2. Gold and silver are not reacting to drama. They are reacting to institutional stress. The DOJ probe introduced a crack, not a collapse. But markets hedge cracks early, not late. Gold moved because credibility is fragile. Silver exploded because uncertainty is spreading. Why central bank independence matters so much to metals? The global system runs on one assumption. The Federal Reserve controls money without political orders. That belief supports the US dollar's reserve status, low borrowing costs, stable inflation expectations, global demand for US debt, gold prices that belief. The DOJ probe didn't just question Powell, it questioned whether the Fed can operate without fear. Even if nothing changes in policy, the possibility of pressure is enough. Markets don't need proof. They hedge against risk scenarios. Historical pattern when gold sends early warnings. Look at past events where gold moved ahead of crises. 2007-2008, gold rose before the financial crash became obvious. 2020, gold surged before full lockdown economic damage was visible. 2022, 2020-23, gold rallied ahead of inflation, becoming politically undeniable. In each case, gold reacted to policy credibility strain, emergency monetary expansion, institutional stress. This situation fits the same pattern. Different trigger, same reaction. Why $5,000 gold is being discussed seriously. Is $5,000 gold guaranteed? No. Is it random hype? Also, no. $5,000 gold enters the conversation when markets start modeling. Sustained political pressure on monetary policy. Forced rate decisions. Inflation control becoming secondary to growth or politics. Loss of global confidence in U.S. fiscal discipline. Gold prices move not linearly, but in repricing waves. If confidence erodes gradually, gold climbs steadily. If confidence snaps, gold reprices violently. That's the risk. Markets are now hedging. The DOJ probe into Jerome Powell introduced a new variable. Markets hate. Legal pressure on monetary authority. Political influence risk. Policy unpredictability. Stocks can ignore that for weeks. Gold reacts instantly. That's why gold often spikes before recessions, currency devaluations, inflation shocks, financial crises. It's not predictive. It's responsive to structural weakness. Why silver explodes instead of rising calmly. Silver is not just a smaller gold, it behaves very differently. Silver sits at the intersection of monetary metal, industrial commodity, speculative asset that makes it volatile by nature. When confidence cracks, gold moves first, institutional hedge. Silver falls harder, speculative acceleration. Think of silver as leveraged trust loss, and that's why silver rallies faster than gold, crashes hotter than gold, overreacts in both directions. When silver starts moving violently, it usually means risk appetite is shifting fast. Why central bank independence matters so much to metals? The global system runs on one assumption. The Federal Reserve controls money without political orders. That belief supports the US dollar's reserve status, low borrowing costs, stable inflation expectations, global demand for US debt, gold prices. That belief. The DOJ probe didn't just question Powell, it questioned whether the Fed can operate without fear. Even if nothing changes in policy, the possibility of pressure is enough. Markets don't need proof. They hedge against risk scenarios. Dual historical pattern when gold sends early warnings. Look at past events where gold moved ahead of crises. 2007, 2008, gold rose before the financial crash became obvious. 2020, gold surged before full lockdown, economic damage was visible. 2022, 2020-23, gold rallied ahead of inflation, becoming politically undeniable. In each case, gold reacted to policy credibility strain, emergency monetary expansion, institutional stress. This situation fits the same pattern. Different trigger, same reaction due to why $5,000 gold is being discussed seriously. Is $5,000 gold guaranteed? No. Is it random hype? Also, no. $5,000 gold enters the conversation when markets start modeling. Sustained political pressure on monetary policy. Forced rate decisions. Inflation control becoming secondary to growth or politics. Loss of global confidence in US fiscal discipline. Gold prices move not linearly, but in repricing waves. If confidence erodes gradually, gold climbs steadily. Up to now, we've talked about markets, metals, and institutions. Now we narrow it down to what actually matters to Americans. Start with one hard truth. Inflation is not just about prices going up. Inflation is about loss of trust in purchasing power. People often think inflation is caused by corporations, supply chains, oil prices. Those matter, but they're secondary. The core driver of inflation is whether people believe the money they earn today will still buy the same value tomorrow. That belief depends almost entirely on the credibility of the Federal Reserve. So, why this DOJ situation raises inflation risk, even without policy changes? Here's the part most people miss. Inflation expectations can rise before inflation does. The DOJ probe into Jerome Powell introduces uncertainty around who really controls rate decisions, whether political pressure could override inflation control, whether future crises will be handled independently. If markets believe the Fed might be pressured to cut rates too early, print more money, support government borrowing, then inflation expectations creep up, and once expectations rise, inflation becomes harder to contain. Let's end this the right way, clearly, calmly, and without hype. This entire story was never about headlines, it was never about shock value, and it was never really about Jerome Powell as an individual. It was about trust, because modern money doesn't work on metal backing anymore. It works on belief that institutions act independently, rationally, and without fear. And the moment that belief wobbles, markets respond before people do. Joss, what just changed? In one sentence, for the first time in modern history, the credibility of the Federal Reserve is being questioned not by opinion, but by legal pressure. That is the shift. Not collapse, not chaos, but fragility where certainty used to exist. But why gold and silver are the messenger, not the message? Gold and silver didn't cause this moment. They reacted to it. They always do. Gold doesn't care who wins elections. It doesn't care about speeches or promises. It reacts to credibility risk. When markets start asking, can policy still be independent? Can rates be set without pressure? Can inflation be controlled if politics interferes? Gold answers by moving. Silver answers by exploding because it amplifies fear, speculation, and uncertainty. That's not emotion, that's mechanics. Tron, why this matters, even if everything turns out fine. Here's the uncomfortable truth most people don't want to hear. Damage doesn't require disaster, it only requires doubt, even if Powell is cleared. No charges are filed, the Fed continues operating, the precedent has already been introduced. Markets now know the Fed is not legally untouchable. And once a firewall is questioned, it never fully returns to its old strength. Why the $5,000 gold talk exists and why it's misunderstood. Is $5,000 gold guaranteed? No. That number exists because markets are modeling risk ranges, not predictions. $5,000 gold becomes plausible only if political pressure affects monetary decisions. Inflation control becomes secondary. Confidence in long-term policy weakens. It's not about price targets. It's about what breaks first. If stress continues, smart people don't obsess over the number. They focus on the conditions. Washed. What smart Americans actually do in moments like this. They don't panic. They don't go all in. They don't ignore signals. They do three simple things. 1. They stop assuming stability is permanent. Stability is earned daily, not guaranteed. 2. They reduce unnecessary leverage. Debt hurts more in uncertain systems than slow growth ever will. 3. They diversify trust, not chase returns. Not everything should depend on one institution, one policy path, or one promise. That's it. No drama, no doomsday prepping, just realism. So toi, the biggest lie people believe about money, that you'll get a clear warning before things change, you won't. By the time consensus agrees something is wrong, assets are already repriced, purchasing power is already lost, policy options are already limited. Gold and silver move before consensus because they don't wait for comfort. They move on risk. Estual, where this leaves America. America is not collapsing, but it is transitioning from absolute confidence to what? Conditional confidence. That's a big difference. And conditional confidence demands smarter behavior from markets and from individuals. So, final truth, no sugarcoating. This story wasn't about Powell. It wasn't about metals. It wasn't about fear. It was about recognizing when the system becomes less forgiving of mistakes. Gold and silver are not screaming rut. They're quietly saying, be careful. The margin for error just shrank. Ignore that if you want. Markets won't.